say that the investment process is a series of lily pads. And you're trying to jump from pad to pad, and the questions you need to ask yourself at each of those lily pads are different. And so, when you get a deck, I have 30 seconds or 2 minutes to decide if I want to have a coffee meeting or 30-minute Zoom with this founder. So I need to ask myself, what needs to be true about this deck that makes me want to give up 30 minutes of my time? And usually that's around, I'm like really intrigued, or there's something compelling, and it's usually I understand this customer problem and it seems like it's happening in a really big market. Then with the coffee chat, there's another series of questions that I'm asking, which is how clearly can this founder articulate that problem, and why is she or he uniquely qualified to knock it out of the park, and how big could this be? And then that makes me want to go into DD. And then in DD, that's when I'm actually looking at the product, I'm looking at their sales and marketing chops, I'm looking more deeply at the problem, I'm talking to customers, speaking to experts, and that is making me decide whether or not I want to make the investment. And then of course we go into terms and negotiating the finer points. But I think it's important for us to let founders know that when each stage of that process, I'm not deciding, am I investing? I'm saying what needs to be true to advance the process.
That's right.
And so there's a different series of questions I'm asking, different things that need to be true, and a different level of diligence that I'm putting into each step of the process.
So how much should founders prepare the diligence for you? If they are making an approach to a particular firm, how much DD should they literally do to ensure that they're providing?
I can give you a starting point. The first thing that would be great is if you just read the investor's website. Because honestly, I think a lot of founders approach VC firms and think that every VC firm can invest in every type of company, and they don't realize it's actually a Venn diagram where the founder needs the check and the terms to work for them, and so does the investor. And no matter how great your fintech is, Tim is not going to invest in it because it's not part of their mandate, because they haven't raised their money from their investors to be able to invest in that type of company. And it might be around the size of the check as well. Oftentimes we get people coming to us saying they want to raise a $5 million round. You're like, well, that's fantastic, but we're not going to be, a large enough check to participate in that round. So you're wasting your time by coming to us. You're better off going to other groups. So the first step is just read the website, and then it's common sense.
I think that there's a Goldilocks, especially for me as an early stage investor. So I think that good founders are structured thinkers, and structured thinkers have materials that they want to share with me. And so I always say to founders, don't create materials just for me, for due diligence, because that is a waste of time. But good founders have put their thinking or their strategy, they put ink on paper, and they want to share that with me to help communicate their vision. So I love when I see that. If I look at a spreadsheet looking at financial projections, I always say more fiction is written in Excel than is written in Word. So I don't believe those numbers at all. But I use that as a proxy. And the proxy I'm looking at is, how does this founder think about the growth trajectory of this company? And what kind of ambition do they have? And is it realistic? Is it ambitious enough? Is it too incremental? So I use it as a proxy for thinking. The same thing about product. When I am investing early, that's not the product that's going to make me lots of money and change the world, but it's a proxy for their product sensibility. How do they understand the problem, and how are they thinking about solutions in different ways? So what they have in their data room for me is it's almost clues. So it's not answers, it's clues, and then it's my job to hold up the magnifying glass and to decipher what these clues mean.
To be clear, the data room includes a pitch deck,
Yes.
financials,
Yes.
cap
Sometimes.
table.
Yeah,
Cap table, what else would you be looking for in that set of documents, if you like, for a founder?
I think there's a misnomer that investors look at things in a data room for the sake of looking at things in a data room, and that they're not actually requirements to run a company. And so I do think that these are things that a founder should have in place if they are structured thinkers. And it's the key information. You would have employment agreements if you have employees. You'd have a shareholders agreement. You'd have your financial model. You might have a profit and loss and a balance sheet and those sorts of things in there. But it's the sort of information that the founders should be using to actually run their business too.
Yeah, I think, look, ultimately, if you're a founder and you're raising capital, ultimately you want to reduce that friction into raising capital. And anything that creates difficulty or friction or extra clicks for that investor to do, and that includes reconstructing a financial model, especially in the later stages, just makes it harder. And I think founders are just so incredibly talented at reducing friction on the customer side and on the product side. Anything that you can do to make it easier for an investor and make it a faster decision is better.
So what's one question then, you've got that process, you've got your documents, what's one question that you would ask or have asked of a founder that reveals a lot? You know, when you're assessing, you were talking before about you're assessing for, are they thinking big enough? Are they able to be the magnet? What's a question you could ask them that's going to be really revealing from that point of view?
The first question I ask, so I always introduce myself first, and I take 15 seconds to do that, and then I say, I want to get to know you a little bit better, and this is the question I always ask. You could be doing anything in the world. Why are you waking up every morning and going to bed every night focusing on this problem? And that's where I want to appreciate their understanding of the problem and their obsession, because that is what's going to help them go the distance. It's not going to be their financial model or they're really good at coding, or like, it's going to be that day in, day out, they care enough about this problem that they are going to dedicate the next 10 to 12 years of their life on it. So I ask them that question, and I usually find out something personal about them as well, and I understand their why.
So what about if there's an opportunity that comes your way that doesn't fit your pattern or your thesis, but it's a white space opportunity and you've got high conviction on that?
Well, actually, I'll give you 3 quick examples of actual companies that are outside of our stated thesis, and I'll tell you why we made those investments. So the first one is Heaps Normal. So we're very clearly, we invest in technology, whether that's software or hardware, not in CPG or FMCG companies. And here we are investing in a beer company, non-alcoholic beer. So why did we do that? Because we knew the founders and they were incredible. And there's like all this story that we told ourselves at the time because they were kind of selling DTC, that it was more subscription. It was kind of like software, but really we thought the category was going to go gangbusters, and we were right. And we thought that this team were really knowledgeable and super passionate, and we just wanted to be on their team. So we broke the rules because we met great founders. And we have over $1 million in that company, and we're so excited about what they've done.
We would make an exception for a founder. And I think the founder also probably blends into your description as well, where they can identify a market shifting or potentially a technology, technological change, but it would always be centralized on a founder. And one example of that recently is probably Semble. This is a company that we've put almost $1.5 million into over the last year or so. And that is a learning platform for kids 0 to 5 years old. So it's EdTech business, but they started off by buying kids' books off the shelf on Amazon, repackaging them into a book subscription package, but they're now developing their own books using best practice from research articles to improve learning outcomes and help kids with developing emotional maturity and all these sorts of things. And that's a company that we've backed because of the founders who've got experience raising dozens of millions of dollars in venture capital and have got deep domain expertise in EdTech.
And we joined you in that investment,
Yeah, I'm pretty sure.
breaking our thesis as well.
Yeah,
So there you
that's
go.
one of our co-investments.
Double deviance.
There's some more money coming in there if you want it.